Liquidity stress is back. The repo market is cracking once again. SOFR is above the Fed's upper limit, and firms are rushing to the Fed for dollar liquidity, over $24 billion over the past 2 days. And the chair of the Financial Stability Committee at the Fed has a shocking new warning. So liquidity stress is back. Another Fed official is warning of the basis trade and risks associated with that. Of course, financed in this repo market that we're going to dive into today. The Fed's emergency liquidity standing repo facility tapped for $24.6 billion over the past 2 days. And SOFR, the secured overnight financing rate, arguably one of the most important interest rates in the world, is now above the Fed's upper bound. So just a kind of general overview here. Remember, we're looking at a spread between two interest rates. SOFR, which is the interest rate that is determined by the actual supply and demand of dollar liquidity in this $3.2 trillion repo market. SOFR is the actual interest rate dependent on the supply and demand for liquidity. If you are the only firm on Wall Street that has $100 billion and everyone needs $100 billion, well, you get to set a very high price. The price with money is the interest rate. And we're looking at it relative to the reverse repo award rate. That is the red line here. That is the Fed's way of trying to set a lower bound for the overnight cost of capital. So we're looking at a spread between two different interest rates. And of course, this was the 2019 repo rate crisis. We'll get to that in a second. As we can see over the past 2 days, SOFR minus RRP is heading sharply higher once again, and we are now above the Fed's upper bound. Of course, Fed funds has also been ticking higher. Remember, that is the unsecured overnight interest rate. There's a different range that the Fed uses for that, but that has been ticking up recently as well. And not only that, but as we can see from turning on the standing repo, anytime the standing repo was used, this is definitely not normal. So not only is the moving average heading higher, there's a lot of day-to-day volatility with SOFR and relative SOFR spreads. So you use the moving average, and you can see not only has liquidity stress been building, but you also have it in the unsecured market, and you couple that with the fact that the standing repo is getting used now kind of out of nowhere. All of the sudden, the standing repo is getting tapped. That is the Fed's emergency liquidity backstop. Now, remember here, we can see that the moving average was actually headed lower, indicating more ample liquidity, and then we had the 2019 repo rate crisis. So the moving average heading higher is arguably even more important now, and I'll remind folks, it is not quarter end. Of course, it is normal to see some liquidity stress at quarter end, but we are not at quarter end. So moving on here, we can see the ranges, the static interest rates that the Fed uses to try to control the overnight cost of capital. Now, there's two ranges. So for the Fed funds, for unsecured, they use IORB, the green line, and the red line. That is the range to control the Fed funds. And as we can see for this period of time, it was right in the middle of those two ranges. Well, look at where it is now. It is almost at the upper bound. If we head to SOFR, the $3.2 trillion SOFR market secured overnight financing rate, that is actually higher than the Fed's upper bound. For yesterday, the volume-weighted median came in at 4.01. The discount window and the standing repo, the interest rate on those two facilities right now, 4%. So we are headed above the Fed's upper bound when it comes to SOFR, and we are very, very near to the upper bound with the Fed funds, which is unsecured overnight lending. Now, remember, there is a distribution. There's a breakdown here. Not all of the 3.2 trillion gets financed at the same rate. Well, here we can see the relative distribution. What I want to point out, if you go to the 75th percentile, we have been above the Fed's upper bound for a long time now. We had about 2 or 3 days of kind of respite, but generally speaking, 25% of that 3.2 trillion has been getting financed above the Fed's upper bound. Why are they not going to the standing repo facility, which is, the Fed defenders will tell you, well, the standing repo is there, everything's fine. Well, what that tells you, what this breakdown tells you, is that 25% of the 3.2 trillion is going, no thanks. We don't care about your 4% standing repo facility. We would rather pay 4.07, 4.03. We would pay a higher interest rate to not use that facility that you are trying to provide us liquidity through. And of course, that is due to stigma mainly. Here we can see that 75th percentile SOFR minus relative to the discount window rate or the standing repo rate, which is, of course, the Fed's upper bound. Here we can see it has been above the Fed's upper bound. 25% of that 3.2 trillion has been getting financed above the Fed's upper bound. Now, here, zoomed in is a way to think about liquidity conditions for the plumbing of the financial system. Here you're looking at the reverse repo, which again is a storage tank for excess dollars. It was sterilized excess liquidity that the Fed was trying to prevent from going out into the real economy or the banking system, minus the standing repo facility. And as we can see recently, it has been flirting with negative territory, indicating that we are transitioning from an ample liquidity regime to a scarce liquidity regime. The fact that this is going below zero. Reverse repo storage tank for excess dollars, that is basically empty. So there's no longer a shock absorber. There is no longer a buffer. The reverse repo empty on its own is not necessarily that big a deal. It is more the removal of a shock absorber from the plumbing of the financial system. And in large part, this has been drawn up due to the TGA liquidity conditions, very tightly correlated bank reserves, very tightly correlated with SOFR spreads, as we can see from the green and yellow line. But the TGA has been getting rebuilt. So it has gone from 300 billion to 900 billion. Well, that 600 billion that had to go in the TGA, remember, the reason for that is the huge amount of bill issuance. Remember, bills are very short-term Treasury securities getting rolled very frequently. Well, that means the Treasury needs to be able to withstand a 5-day shutdown. And so because we're financing so much debt short-term, overnight payday loan in the cash markets, the Treasury needs to have a larger buffer because we are rolling our debt so frequently. Well, that buffer right now, $900 billion. Remember, when they built this up, it could not come. $600 billion was not available in the reverse repo. There's only about $190 billion. This is when I first started warning of a liquidity crunch, was back then when they announced they would build it up to $900 billion or so. I looked at the reverse repo, went, well, can't come from the shock absorber. It's got no money or not enough money to rebuild it, meaning bank reserves have to decline. Well, when bank reserves decline, remember that is the monetary base declining. And we can see a very tight correlation, inverse correlation with SOFR spreads. As bank reserves move lower, the scale all the way on the far right, as bank reserves move lower, SOFR spreads widen. Now remember, the $1.8 trillion basis trade is financed in the repo market. And of course, 2019 was one such stress for that basis trade where you are long cash treasuries, short futures contract, but it's blown up other times as well. March 2020, early April, earlier this year. Now, here's a look at the standing repo. As you can see, going all the way back to late 2023, we can go even further back, and you can see that the standing repo was basically never used. And it was certainly not used in this amount of size going all the way back to 2020. So zooming in a bit to that ample liquidity versus scarce liquidity, this is the first time that we have been at -8 billion going all the way back to July of 2020. So we are in a new liquidity regime, and we have a top Fed official warning of the risk that $1.8 trillion basis trade poses to the $30 trillion U.S. Treasury market, our sovereign debt market, the collateral, the global reserve collateral for the financial system nowadays, the U.S. Treasury. Well, that market, that $30 trillion Treasury market, is threatened by the $1.8 trillion basis trade. Lisa Cook, I will link this, but I think there's only three views, so you got to be fast. I will link this article, but Lisa Cook, chair of the Financial Stability Committee at the Federal Reserve, has added her name to the kind of growing list that I have here of the various Fed officials warning about the repo market. So again, a lot of people like to downplay, oh, it's really not that big a deal. Well, all the top Fed officials, they all think it's a big deal. Jerome Powell, former SOMA manager, current SOMA manager. Now we have Lisa Cook, the financial stability governor. They are all warning. They are all worried about something. So I think that is worth paying attention to. Anyways, hopefully that was helpful, and I'll catch you in the next one.